All right, welcome to BA 211, which is your financial accounting course. For many of you, you've never taken an accounting course, so some of you might find it to be a bit of a challenge, others, and you might not like it. But if you're going to go into business, this is kind of the way people talk about business through accounting. So this is why you have to take accounting, because it is the, as they say, language of business. So even though you're not an accounting major or not planning on it, I hope some of you do. You need to understand these accounting concepts. So that's why this is an important class for all of business students, not just accounting majors. All right, so chapter 1 is your typical introductory chapters. It just introduces you to some of the players, some of the concepts, some of the terminology. You know, if you don't quite understand it all after the first chapter is done, these concepts get harped on repeatedly. So even if you don't get it right up front, hopefully you'll get it before the term ends. All right, so chapter 1, accounting for decision making. That's really what accounting's all about. It's, as the beginning, accounting is not the end all. It's, accounting is a means to an end, and that end is helping managers and, depending on the type of accounting information supplied, outsiders to make better business decisions. So making better business decisions through utilization of accounting information is really the ends to the means, or the end to the means. And so they move right into the little diagram on page 5 or 6, I think 5, which kind of shows the relationship of the accounting process, which involves several things and different players. And the whole idea is to take this accounting process, the output of the accounting process is accounting information, whatever that might be, and there's all types of accounting information involved. We'll talk about the fact that most accounting information falls into one of 3 categories, either financial accounting, managerial accounting, or tax accounting. But this class is financial accounting, so that's primarily what we're going to be talking about. But some of these concepts also apply, or these concepts also apply to managerial, which is the second term class. And if you're majoring in accounting, you'll take tax accounting. So you'll see how this accounting process applies to those 2 types of accounting. And so this accounting process collects information from economic activities of the company. And the accounting information accumulates this information, organizes it, and reports results to decision makers so that they can react accordingly. If things are going as planned, then you keep things going hopefully as they are. If things are not going as planned, you as the decision maker may need to make some revised decisions as to what economic activities the company takes. So this just shows that link between using accounting information by the decision makers and the economic activities that these decision makers decide the company should take. And again, the types of accounting information you have are financial, management, and tax. This is financial accounting, so that's primarily what we're dealing with in this term. And so the first thing we need to talk about is the accounting system. And so the accounting system is a broad spectrum of the personnel, the hardware, software, procedures, etc., records used by the organization to develop this accounting information, gathering it up, organizing, and communicating that information to decision makers. Now, this shows you how financial information is provided by the information system, the accounting system. Accounting is information. Mostly it's numbers, not always. For financial accounting, everything revolves around the numbers. But the numbers don't tell the complete story. So there's more to the accounting information system than just the numbers, okay? There's these things called notes to the financial statements, which give explanation to what the numbers mean. Future plans, things like that. Subsequent events that may change the decision maker's options. Anyway, what comes out of the accounting information system on the financial accounting side is three financial statements. They're called general purpose statements. And those general purpose statements present the company's profitability for a certain period of time. Most of you probably know what that means. What is profit? Well, it is in its basic form the revenues of a company minus its expenses, right? And so that equals either gross or net income depending on the type of business you have. And usually it's over a period of time. If it's a yearly statement, it's for 12 consecutive months of operations of the company. We'll talk more about that in the future. Financial position. What this does is it shows the company's assets, the company's obligations, and what's left over after assets are used to pay the obligations is called owner's equity or shareholder's equity or something to that effect. So that's kind of an important thing. This is a snapshot of the financial position of a company at a certain point in time, on a certain day. Statement of cash flows is important because cash flow is the lifeblood of the company, and decision makers need to know whether or not, and again, this stuff is based upon past history, and so if you're a decision maker, you have to decide if you're making a decision for what's going to happen in the future with this company, and you're hoping that past performance is prologue to future performance. It's not always the case, which is why sometimes you have to dig deeper than just the three general purpose financial statements. Now, the users of these three general purpose financial statements are, to a greater extent, outsiders, people and institutions which are not involved with the everyday running of the company. Potential investors, investors who are not employees / managers, directors, suppliers, regulators, creditors, potential investors, all that. These are people who run the company, not involved with day-to-day operations. The book breaks it down and simplifies it even further. There's two categories of outside users. Those are investors and creditors. And when they say that, it includes potential future investors, creditors. And that's true. That for the most part is the case. But there are other players, outside players that need these financial statements. The decisions supported by these three general purpose statements are lending decisions is a big one. Whether or not to lend money to a company. You've got a 30-year loan that they're applying for. Looking at the financial performances to determine if this company is going to be around for the next 30 years to pay this debt. Again, your best guess as to future performance is past performance. Nobody has a crystal ball. If you're a supplier, you want to make sure that might be a little different decision if you're a supplier who paid in 30 days rather than 30 years. But you make sure you get paid on that multi-million-dollar supply made to the company. So still, it's a matter of you're giving them your stuff, and as you may know, most business credit suppliers this on credit terms of 30 days, 60 days, 90 days, whatever. It is what makes the world go around. Most of this is not cash in advance. So suppliers, potential suppliers, want to see these financial statements to make sure your company is going to pay the bill. And then there's other stations, especially government IRS requires certain taxes and requires companies to store that information and report it every year. If you're a publicly held company, meaning you sell stock on one of the public stock exchanges, Securities and Exchange Commission, the SEC, requires that you report annually audited, what we call audited financial statements, which we'll talk a bit more about. So, I mean, there's legal requirements of certain companies that require you to accumulate information, store it. What this points out, it says, although much accounting information clearly is essential to business operations, management still has many choices as to the types and amounts of accounting information to be developed. True, as long as standard, regulatory groups, IRS, SEC, as well as the information required by rules of accounting, which we'll talk about. And so the basic function of an accounting system is to, well, I would back this up even further. The basic functions of an accounting system is to gather business transactions. We'll talk about what is a business transaction, because that's kind of a term of art. Not every business is a business transaction that must be recorded. But first thing you have to do is accumulate this information in a central place, the accounting system, and then you interpret and record the business transactions. We'll talk about how you do that. You classify similar transactions into useful reports, and essentially you have to take a bunch of transactions, and by classifying them, You're able to summarize that information and communicate it to decision makers. One thing that, and this you may know, you're already out there in the working world. The higher up you go in an organization, the less detailed information you want. And so, as I get up higher in an organization, I want less detail, more summary, get to the point type of information. One important thing that a company must have in order to have a reliable accounting system, and it goes beyond the reliability of the accounting system, they must, for any organization, in order for them to continue to be viable, they must have these things called internal controls. Rules, policies, things like that protect the company's assets as well as that. Well, let's say you sell. What do you think might be a threat to the viability of a company if you sell inventory? Well, one thing, theft. And you'd be surprised, or maybe you wouldn't, to know that one of the biggest threats to companies is by employees. Rules have to be made to protect those assets. You restrict of your employees to inventory. Only certain authorized people have access to inventory. Controls make sure that from one department these internal controls in place to that follow the trail to its destination. So there's a lot of things involved in internal control, and it goes way beyond just the accounting system, but you know, like internal controls on handling of cash. Again, if the biggest problem for companies is employees, what do employees want more than the handling of cash? And so it starts with what we call the control environment. It really starts with the mindset of management. And again, if you don't quite get all this, that's fine, but management sets the tone for internal controls and how its employees treat those internal controls. If top management is not following the rules of internal control, it's unlikely that the employees under them will also. It requires the company to make certain assessments as to our cash risk if we don't have these particular internal controls in place. You have certain activities meant to control the assets of access to inventory, restricting access to cash, recording a trail, things like that. And then you have information and communication. Now, I'm not sure what they're talking about there, but I think I do. Have to give information, have to communicate information to employees as to what the rules. You have to. And then on top of all that, you have to monitor to see whether or not internal controls are being enforced and if they're effective. If not, time to change. Why is internal control, and again, this doesn't just relate to the information system, but it's part of the system. Why? Because think you have some amount of inventory, but yet some of it or a bunch of it's been stolen. Well, that means your inventory records are off and you don't know it. What does that do to numbers? Well, it means you're going to show more inventory on the books than what you actually have. So by having proper internal controls through proper rules, the numbers are likely to be more accurate. The next thing the book talks about, and I don't want to spend a whole lot of time on this because this is not really the focus of this BA 211, but we'll talk about it a little bit. The external users of accounting information, again, are potential investors for the most part and creditors. I don't even know why they're going through this. And again, they're understand that the information these users, these external users, it's of an income statement, a balance sheet. Some call the balance sheet statement of position. It just these liabilities time and statement of cash flows. That's all these outsiders are getting, but they're using that for different. So when it talks about providing specific information of economic resources, those are your assets. Claims to those resources, that's your liabilities. And what is left over is claims of the owners, okay? So there's claims to resources. Some are from outsiders, creditors, etc., suppliers. And then what's left over, the residual, is claims of the owners. And then you have your changes in resources and claims. That's really getting down to your your changes in cash flows and things like that. Providing information useful in assessing the amount, timing, and uncertainty of future cash flows. Again, the statement of cash flows deals with cash flows in the past. Is that some indication of what the company's cash flows will be in the future? Yes, deeper than the statement of cash flow. The notes to the financial statements, subsequent events, things like that. And so this information provides general information useful in making investment and credit decisions. But if you are one of these potential investors or creditors, you probably need to go deeper. Definitely go deeper than just these 3 financial reports. All right, so there's your 3 primary financial statements. The notes are very important to supplement what's in these statements. And again, the characteristics of this information is it's a means to an end. It's meant to help decision makers make good decisions. In this case, these decision makers are individuals, institutions that have limited amount of contact with the company that provides this information. They're not insiders. Note it says here the characteristics of the externally reported information is broader than the financial statements. That gets back to what I said just a minute ago. If you're one of these potential investors or creditors, you need to go deeper than just the 3 financial statements. Look at the notes. Look at subsequent events. Look at what other analysts are saying. Note, as I pointed out, these financial statements are historical in nature. They are of performance in the past, future. And so the results of your decisions may differ due to subsequent events. Note that these financial results are taken from inexact measures. There's nothing guaranteed about the accuracy of the financial statements. There's no tours of results. A lot of approximations, and you hope you can be accurate, but as you will see in the future, a lot of things are approximate measures and as such can be inexact. And it says here, usefulness enhanced via explanation. That's usually the notes, where the notes of the financial statements come into play. Now, users of internal accounting information. Primarily, when we're talking about users of inside or internal accounting information, you're talking about reports that are not involved with the making of financial statements. I mean, they're involved in making but for the managers, plant managers, inventory managers to make decisions about that affect the day-to-day operations of the. And so it's the hands-on. And so while they, in the long run, affect the three financial statements, the focus is on getting inside information, if you will, make better decisions in doing their job. That's where managerial accounting comes into play. What is a management accounting report? It's basically anything, any type of report that helps someone in the company make good decisions. Be numerical in nature. It might not be numerical in nature. Something as simple as a report that tells you who's clocking in right. Well, that's not really a financial type report. Measure of those people clocking, it tells you you need to chew on somebody, make sure that they're showing up on time. So that's the kind of stuff that you'll get into if you are required. Most of you are business major, and you should be 13. So the primary focus of BA 211 is the three financial statements, general purpose financial statements, and the components that make up that those three financial statements. Doesn't seem like a lot right now, but when you get into the details, it really is. All right, so objectives of management accounting information, you'll see this again, to help achieve goals and missions, to help evaluate and reward or punish decision makers. They don't mention that little detail. Characteristics of management accounting information, timeliness. In order to make good decisions, the information has to be timely. You have to identify the proper decision maker. Note here that the information, especially when it comes to like budgeting, which we'll talk about, is oriented toward the future. A lot of these reports measure efficiency and effectiveness of a particular component of an organization. And just like with other types of accounting information, it's a means to an end. That end usually being making better decisions. As far as the players involved, accounting is very rules-based. It's like sport, you know. What if, the whole idea of accounting is essentially keeping score, right? It's how a company keeps score. It's how the company determines how it's doing. Well, again, this is especially true when you're dealing with companies that sell stock on stock exchanges. If you're an investor or a potential investor looking to buy stock in a company, You want to know how a company is doing in relation to how another company is doing in order to determine whether or not you want to invest in company A or company B, right? Well, what if the companies could set their own rules as far as determining how they're doing financially? So they can set their own financial or accounting rules. Well, you know, that's a recipe for disaster, right? And so, not only here in the United States, but elsewhere, rules have been set up that companies need to go by when keeping score. And so those rules in the United States are called Generally Accepted Accounting Principles, GAAP, GAAP. And those are the rules that companies must go by, especially if they are publicly held companies. But, you know, any company who wants to go get a loan from a bank, and there's a lot of privately held companies like that, must also follow these rules, because the bank's not going to lend money to you, to this company, if they're not following the rules, which is GAAP. Now, the body that sets these rules is called the Financial Accounting Standards Board, otherwise known as FASB. It kind of works like this, actually. The Congress gave the Securities Exchange Commission power to make these accounting rules, these principles, GAAP. But SEC said, well, and SEC, again, is the primary government organization that oversees financial reporting of publicly held companies, not privately held companies, companies who don't sell their shares in public stock exchange. But they hold a lot of sway in the fact that they decided that they weren't going to be the rule-making body. They delegated that responsibility to FASB. Okay. So how does it work? Well, FASB and the SEC work together to create these rules. They take a lot of commentary from accounting professionals and other professional accounting organizations. If there's a proposed principle out there, they get a lot of comments on it before deciding to adopt a certain measure. So SEC has the ultimate power of, you know, approving or shooting down a particular GAAP measure. FASB is kind of the board who oversees all that, but SEC has the ultimate say in the issue of whether or not a particular principle gets adopted. There is of course, every country has their own accounting rules, some not as strict as the United States, certainly. Many countries have adopted what we call the International Financial Reporting Standards, IFRS, and those rules are set by the International Accounting Standards Board, IASB. And so There's been some effort to integrate GAAP with IFRS. It's not totally integrated, and the SEC indicates some skepticism as to whether or not it ever will. So, you know, as long as that's the case, I mean, if you're an international company who also does business in the U.S., you're probably going to go with using IFRS standards so that all countries take your financial statements. And again, the SEC allows either IFRS or GAAP for international companies who are also publicly traded in the U.S. There's this thing called the Sarbanes-Oxley law or statute, act, I guess you might say, of, I think, 2012. And out of that came this Public Company Accounting Oversight Board. This board, well, the main job of this board is to oversee the accounting profession and how the certain accounting firms audit the financial statements of publicly held companies. More on that if you're an accounting major later. What they're talking about there, audits of financial statements, that's what certified public accountants, CPAs, do. They're independent accountants, not a part of a firm. They're hired by the firm. They come in and their job is to determine whether or not the company's financial statements fairly represent the financial position of the company. Okay? And so they're not giving scores that the financial statements are absolutely correct, but they have to follow certain guidelines in their audit to follow certain professional responsibilities in doing the audit to give the public, and this is mainly for public companies, the public has to be reasonably assured that the numbers are correct, okay? And so that's where the PCAOB comes in. They set the rules for these CPA auditors of publicly held companies. You also have professional organizations involved. The American Institute of CPAs, AICPA, is an important part of this. They give a lot of advice to the FASB group when a new procedure is out there. They also set rules for CPAs on how CPAs must act ethically in order to maintain their licensure. Not every accountant is a CPA. You have to apply to the state that you're in, that you reside, for the CPA licensure. You have to meet certain educational requirements. You have to meet certain ethical requirements. The licensure, you have to pass the exam. And then you have continuing education after you pass the exam. You also have a continuing ethical obligation. So it's kind of important to have ethical CPAs. There's other types of accountants. If you're a management accountant, you just work inside a company CMA, I guess it's CMA, Certified Management Accountant. And then you have something called an internal auditor. We'll talk a little bit more about that probably in the future. You can become a certified internal auditor, a CIA, not related to the covert operation. American Accounting Association, mainly that's for educators, but some CPAs are involved with that as well. You have the Committee of Sponsoring Organization of the Treadway Commission, COSO. The main thing there is that the Sarbanes Act on companies having proper internal controls. As a matter of fact, when an auditing firm audits a company, they're not only auditing the financial statements, they're auditing the system of internal controls for that public company and render an opinion on the effectiveness of those internal controls. And so things that the Act, Sarbanes-Oxley Act did was said that companies have to adopt a framework of internal control. And so where COSO comes in is they've created a framework of internal control that most companies have adopted a system of internal control. So that's where COSO comes in. And so if you're an accounting major, this is going to be harped on you for ever and ever. But it's true of all business people. You have to have competence. That's what we're here to teach you. That's what you're here to learn. You have to have good judgment. And then you have to be ethical in your behavior at all times. And that's true if you're an accountant or anything. Shoe salesman, car salesman, manager in a company, you name it. But especially for accountants, ethical behavior is extremely important. But company, does that mean you can still be good at your job and not be ethical? Well, no. Because, quite frankly, if you read the scandals, the corporate scandals that occurred over the last years, from the top managers, not the accountants, but yeah, accountants need to be ethical too. What can you do with an accounting degree? Again, if you like accounting, if you become good at it and you like it and you want to start your career doing it, probably if you start your career doing it, that's probably not where you're going to end up. The old joke, what do you call an accounting major 5 years after graduation? And the answer is boss. Many people start out in accounting, and because they know the numbers so well, they can make good decisions. And so they move up the ranks into management. But some people have careers in just accounting. So if you decide to do that, you can be in public accounting. You have to be a CPA to do that. You can be a managerial accountant. You can be a government. You can be me. You can be an accounting instructor or professor. There's a lot of things you can do with an accounting degree. Now, some would ask, well, is bookkeeping accounting? Well, accounting is much broader. Bookkeeping is simply the clerical side, the record keeping routine. Frankly, if you out seriously, if you want to be a bookkeeper, if you took accounting in high school, you probably got that taste in your mouth, because what you were really doing is bookkeeping, the clerical side of accounting, the recording of routine transactions and day-to-day record keeping. Now, might there be some of that if you're an accountant? Well, yeah, sure. And you have to do this, but really, there's more to being an accountant than just that. It's taking the information, interpreting it, analyzing it, making good decisions from it. Again, my earlier point, if you're not an accounting major, why do you need to take this? Imagine you're in a meeting with your boss and it all gets back to the numbers. If you don't understand accounting, numbers, how it all relates, and you don't want to look like an idiot to your boss. So you want to be learned in your profession, and as I say, accounting is the language of business. So you speak the language of business, which is accounting. So one way you can do that is understand accounting. So it's very important. I urge you, whether you're a management major, economics major, marketing major, or whatever, take as much accounting as you can, because it's just going to make you that much more learned to your bosses, to your organization, and much more useful. Big thing that's come into vogue since some of the early scandals of the last 15, 20 years is this thing called corporate governance. And it just entails corporate structures and processes for overseeing the company's affairs to ensure that the company is being managed with the best interests of shareholders in mind. But it goes beyond that. I mean, these days want to be a good corporate citizen, and so it goes beyond just the shareholders. It goes beyond other stakeholders, such as people in the community in which they run their business. I mean, you don't want to be a polluter in the community. Right? That doesn't make you a very good corporate citizen. So, I mean, it goes way beyond just keeping the shareholders' interests in mind. It's making sure relations with all your constituents. That's the end of chapter 1. It's pretty cut straightforward and clear cut. So anyway, the assignments are in Connect as well as the quiz.